Markets help the financial manager to maximize wealth for shareholders. Now, the learning goals for this chapter, we want to understand what role the financial institutions play in managerial finance. And for you, you may want to understand what are financial institutions and how do they differ between banks and brokerages, commercial bank, private bank, credit union. So how do these financial markets affect financial managers and how they run companies, how they raise money, differences between a money market and a capital market, how regulation and the regulatory environment affects financial institutions, which affects financial markets and affects financial managers, as well as what's the process for a company to go public, to issue common stock. How does the investment bank, what is an investment bank? Can I work there? Sounds like I hear they make a lot of money to work in an investment bank. How can I do that? And what do they do, actually? Maybe I don't want to work there. But we'll find out in this chapter, as well as talking a little bit about the financial markets and the different crises they've had, specifically the root cause of the Great Recession that just happened over 10 years ago, and probably getting pretty close or getting ready for the next big financial crisis to come. Hopefully not when you graduate. Hopefully you can graduate before then and get a job, because if you graduate during a financial crisis, it's hard to get a job in business. Okay, so financial institutions, they're the go-betweens. So basically, we have people who save money and people who invest money. So the financial institutions are in the middle there to move the money from people who are saving it to people who want to spend it. Now, the general size of people who save money, we're talking trillions of dollars here, and most of it, savings comes from individuals, individual citizens, and that money mostly gets funneled to businesses and governments in the form of loans or investments. So the individual who's working a job and saving money, they're the fuel for governments like the U.S. government that borrows trillions of dollars. That comes from small savers, as well as corporations who issue bonds and issue stock. Mostly small savers are the ones putting the money up for those purchases. So when you put your money, if you save your money for retirement, an IRA, a 401k, or just in the stock market, an ETF or mutual fund, that money goes to companies who are issuing stock and raising money to expand their businesses. So you don't get a Netflix without a public stock. You don't get a Tesla without a public stock. You needed massive amounts of money to fuel Netflix's investment in technologies and expansion of content. And you need massive amounts of money to build those factories for Tesla and do the research and development and sell those vehicles. This all takes massive amounts of money. So financial intermediaries are the ones going to be connecting the key suppliers to the key demanders of funds. Now, when you have companies that are newer companies, tech-based companies, if you look at a small area like food delivery, you got your Grubhub, you got your Uber Eats, you got your, what's another one? Bon Appetit? DoorDash. So you get these companies, some of them are public, some of them are private, but when they go public, like Grubhub, they get lots of money from the stock market, and they use this money to create discounts. You know, first delivery free, or $5 off your order, $10 off your order. Same thing like Uber and Lyft. You get emails, 50% off, $5 off the next 10 rides. So these companies are not profitable because they don't have to be profitable because they have all this stock money that they could live off of. It's sort of like you going to school. You're not profitable because you're going to school, but you're living off these loans that you borrowed so you could be here, with the intent that once you're done with school, you're going to get a job, make a lot of profits to pay those loans off, and make even more money to spend and consume and buy houses and cars and things like that. That's how these companies that go public these days are looking at it. Let's get that money up front, get the experience, build the business, the profits will come later. And investors are mostly on board as long as key metrics like sales, or sometimes called revenues, are growing and growing quickly. So in general, individuals are the net supplier of funds. It means individual citizens are saving the money. Businesses and governments are the ones that they're demanding the funds to run the government, pay for the government expenditures. And the government makes investments as well. They invest in infrastructure, they invest in military defense, they invest in public health, they invest in education. So the government will take these funds, make investments. The investors get paid back their principal plus interest, and hopefully if the government is managed properly, these investments return much more economic growth for the country. Businesses do a similar thing. They take the money they get from the savers and they invest it in expanding their operations or buying new operations, hoping to grow the company from a small little DVD in the mail DVD service to a gigantic entertainment company like Netflix. So let's take a step back to banks. So as individuals, you guys understand basically how a bank works. And the basic savers put money in the bank takes that saved money, lends it out at loans, and when they lend the money for car loans, home loans, small business loans, they get much higher interest than the money they pay on your savings accounts or checking accounts. So right now, you're probably getting 0.5% or less in interest on these accounts, and they're writing loans between 2 and 8% return, and that's basic business of banks. So now you have your commercial banks. Now, just to take a step back, before commercial banks, you have sort of banks that are, you can have your credit unions, which are a type of bank, like the Teachers Federal Credit Union, and these are non-for-profit bank-oriented businesses. And typically, these credit unions have the best rates and the best deals for shareholders because they're not after profits, they're just after a member services. Commercial banks may be geared a little bit more towards businesses, where they're certainly in business to make a profit, and these commercial banks are looking to take money from savers and invest it in small, mid-sized businesses. Could be a real estate developer. It could be it could be someone wanting to open up a laundromat. And some commercial banks will also provide mortgages and some more personal services. So as someone who's alive in the world today and has most likely been in a bank or has a bank account, you know basically how this works and the services they offer, such as checking accounts, savings accounts. They have investments accounts as well, money markets, and as well as offering student loans, auto loans, mortgage loans, and these are all a way to take money from people who have a surplus and lend it to people who have a deficit so they can acquire assets. Now, investment banks might be something that you're not so sure about because as an individual, you don't frequent an investment bank because they're not for individual citizens. Investment banks are for companies. So investment banks are experts in raising capital and facilitating transactions for businesses. So as far as mergers and acquisitions, financial restructuring, connecting to the equity markets. So if you're a business that wants to go public, the investment bank is going to help you with that. If you're a business that wants to sell themselves or acquire another business, the investment bank, they have experts, they have accountants, they have lawyers, they have financial people. So they're the ones that help with the banking requirements of more sophisticated, larger companies. So an investment bank is a great place to work because typically the employees are pretty well high paid. It's usually these investment banks generate extreme amount of wealth and profits for themselves, which they pass along to the employees because it's very lucrative to be in this area of banking. And there's also a limited amount of competition. There aren't that many investment banks compared to commercial banks. Now, to make the class sound a little bit mysterious, we have the shadow banking system. So this secret society of shadow banking, which basically the banks, commercial banks, had a lot of regulations on them and a lot of requirements about how they can conduct business because banks were bad in the past and the government had to enact laws to protect citizens from practices that would cause the banks to lose your money and not be able to give your money back to you. So they made a lot of regulations. If you take consumer deposits, this is how much things you have to do to make sure your bank remains safe. And the government is very much invested in that because they guarantee these savings accounts and they'll pay out your balance if the bank is unable to. Now, the shadow banking system is a group of eager lenders. Usually, they're not banks, not traditional banks anyway, but most likely subject would be a large insurance company like AIG. And what these companies will do is they don't accept deposits from individuals, but they have large pools of money from clients that they will reinvest in lending activities. So they're basically another banking system for high wealth individuals and corporations to borrow money outside of most of those federal regulations. And it's a way for companies, like especially insurance companies, who have vast amounts of extra money to make additional money by lending them out at pretty significant interest rates. And this shadow banking system, these lending activities help to expand the amount of capital, which is money, out there to expand and grow the economy and grow businesses. And this recycling of money, bringing it from people who want to save it and invest it to people who want to utilize it to enhance profits, is what propels the economy to move forward. So there was been a massive consolidation in the U.S. banking industry. There used to be many, many small banks, countless numbers of small and local banks that had anywhere from 2 to 20 retail locations. So what occurred, though, is a huge amount of mergers and acquisitions where the amount of commercial banks declined from 14,400 in 1984 to about 4,964 by 2017. So this concentration is basically that little, think of that small fish swimming, a big fish eats it, and then another big fish comes around and eats it. So the bigger banks were accumulating and buying all these smaller banks. So there's been a significant change in how the banking industry works, where you had choices of many different banks. Now you have choices only of 5 or 6 local banks or national banks to choose from due to this consolidation and this. And what accelerated it was the Great Recession, where a lot of banks failed or went bankrupt or were in trouble. So they were very inexpensive targets to take over. So a bigger bank would come in and say, okay, we're going to, you're having problems. We're basically going to just give you almost nothing to take those problems off your hand and assume your locations and your business. Because in banking, sometimes the bigger, the better. So, for example, you like to belong to a big bank, say Citibank or Chase, because they're everywhere in the country. So you could always find an ATM, or you always can find a branch to do your banking with. So the bigger the bank, the more opportunities for you to do banking around the world, around the country. Now, let's look at the relationship between institutions and markets. So financial markets, this is sort of a forum where the suppliers and the demanders are going to get together in a way that they can exchange, transact their business. So the financial market, like the stock market, the bond market, these are financial markets. We call them capital markets. This is where we have a set of mechanisms and regulations to facilitate a liquid market of transfer of funds between demanders and suppliers. So money markets are for any type of financial transaction that has a shelf life of less than a year. So these are short-term transactions, where the capital markets are longer-term, multiple-year transactions. So if you have a 3-month treasury, a 6-month treasury, a 1-year certificate of deposit, these are all short-term marketable securities that take place in the money market. That's why you might hear your bank may have a money market account. They're taking your savings, they're putting it into short-term investments to get a little bit extra interest. The capital markets are much longer term, so corporations in the capital markets, because a corporation lasts forever. Bonds can be up to 30 years, some bonds are 100 years, so they're in the capital or long-term marketplaces. Now there's also private placement, where companies, a lot of the companies you heard of, such as Facebook, Tesla, Snapchat, these sort of companies that came along initially, they were funded by private placement. So before they were public companies, they took a lot of private investments in the company to get them started, to get them going. And then when they get to sort of a big enough stage, then they can hit the public market. So it's sort of a process where you start out very small and you go to the next step. So maybe you start out super small on Kickstarter just to kind of get your business going, and then you go to Shark Tank, and then people take notice, and big investors put some money in your company, and then bigger investors do more private placements, and then you could go to the public markets. So it's a progression, an evolution as a business is proving successful and expanding, and revenues are increasing, interest and awareness are increasing. You get access to more and more funds. Everybody wants a piece of that business. And typically, you make the right private placements, you can make significantly more returns than in the stock market, because you're getting a larger share of these companies at a smaller price early on before they're super successful. However, you can't really get into the private placement business unless you're a multimillionaire and have they don't really accept anything, less than $1 million for most of these companies for private placement. Now, if a company is big enough, they could raise money through a public offering of securities, either stocks or bonds. So if you're a big enough company, an established company, you can access the capital markets and raise money through a combination of stocks and bonds. And most companies will have both because they want this capital to expand their business. So Amazon was a very, very active in the capital markets, and they borrowed money from a multitude of different capital financial instruments to fund the rapid expansion of Amazon, their distribution centers, their website, their advertising, their data centers, their storage centers. All this money that Amazon spent over the years, a good significant portion of that was from capital markets. And for many years they had a loss. So many years the stock price, which is close to 2,000 now, or maybe a little bit above or below, I'm not sure. For many years they were under $100. During the year 2000, after that stock market crash, they were around $20. So as they started to prove that we could take these capital money that we borrowed and turn them into profits, the stock soared. And that's really the name of the game. And now you have companies like Tesla who are transitioning from heavy borrowing in the capital markets to proving themselves in sales of their vehicles and generating profits. And then the stock price increases greatly once they've really proven that, hey, we work as a company, we can make money, we can return to the investors who put money into this company. Now, institutions and markets, we have two types of markets we need to talk to, a primary market and a secondary market. So the primary market is where investors buy the stocks and the bonds for the first time. The secondary market is where these pre-owned securities trade back and forth. So think of it like a video game. You buy the latest video game, and you play it for a while and you finish it. So you spent the $59 to buy the new Modern Warfare, you finished it in 2 weeks, you're done with it, and you go back to sell it and get some money, sell it used back to a store like GameStop or Best Buy, and you spend $60 on it, maybe they give you $30, and then Best Buy will turn it around and sell it to somebody else in the secondary market. So you might just buy a used game and save some money, and then sell the used game. So maybe you bought the Modern Warfare used, and then you played it, and you bought it for $40, and you sold it back for $20. So this copy of this game can go to 3 or 4 different owners, and that's all in the secondary market. But for the person who bought it new, you bought in the primary market. You bought it brand new. The same thing happens with cars. It happens with textbooks, where the primary market is where the item is purchased new, and the secondary market is where it's traded used. So the financial markets have this. When the IPO comes out, that stock comes out in the primary market and sold to new investors buying it for the first time. Then those investors, as the stock price increases, can turn around and sell it in the secondary markets. And you have some shares of some stocks that may have changed ownership over 1,000 times, just going back and forth between these primary markets. Secondary markets. So this is, you can understand this concept of primary and secondary. So basically, think of a lot of websites are only selling primary first purchase goods, and some websites like eBay are a secondary market where they're buying and exchanging used items. Or it could be, in this day, anything could be true in those different companies. But it's very significant in the financial markets because why it's so significant is because companies only get funding from the primary market. They get nothing from the secondary market. That's why Xbox wants to sell Xboxes with no Blu-ray drives on them, because they want you to download all the games from the Xbox store, because Xbox makes more money from that. They don't have to share it with the retailer. So they have a special Xbox that's lower in price because there's no slot for a Blu-ray, because they're willing to lower the price of the Xbox if you buy all your content from them, so they basically cut out the middleman and keep that money. So companies, when their stock trades, if Cisco trades 1,000 times in the secondary markets, Cisco makes no money from that. The brokers, the brokerages and the stockbrokers and the market makers, they'll make money off of the trading, just like GameStop and Best Buy will make money from reselling used video games. But it's important to have that liquidity so that we can see what the valuation of these stocks and bonds are by what the latest trade price is. That's why you can also kind of see in these stores, when you look at used video games or used textbooks or used cars, you get a better idea of what the value is. So if you want to sell your car used, there's services that give you a good estimate of what the car is worth based on what similar models have sold for. So it's a good way of judging value. Here's a chart of the flow of funds, which would be money, basically. So if you're a supplier of funds, which means you're, a typical person, so you have some extra money you want to invest, you could bring those funds to a financial institution, and then the financial institution will thereby take those funds and invest them in the financial markets. Basically means the financial institutions are the ones buying stocks and bonds. You can't buy stocks and bonds directly. You need a financial institution to place the orders for you in the financial markets. That's what a stockbroker does. Now, if you're a demander of funds, you're going to look to receive money from the financial markets. So the financial markets will utilize the financial institutions to sell. The financial institutions will sell the products in the financial markets and return that money to the demanders of funds. So if the demanders of funds are selling stocks, selling bonds, this is going to work through this system. And private placement can be a direct link between suppliers and demanders. So if you're somebody very wealthy and you want to invest in Snapchat, you can make a private placement directly to Snapchat. And there's actually a school in the San Francisco area that made a direct investment in Snapchat and made a huge amount of return based on this direct investment. And then, because eventually that money can be returned to the supplier funds when the company goes public. So as you can see from this diagram, money flows around quite a bit in many different paths. But the main objective here is, if I could save up money, I should either start a business with it or invest it in somebody else's business so I can get a higher return. So if I don't have the expertise, or if I don't want the hassle of starting and running my own business, I can take my capital I've saved and give it to somebody else, like Elon Musk, who can invest it and grow it faster for me. Or give it to a mutual fund manager who's going to have expertise in picking out companies, investing it for you, and growing your money faster. Or if you feel you have a knack for picking stocks, you can directly invest those not directly with the companies, but through financial institutions who access financial markets through a stockbroker, and you can buy individual stocks yourself and become part ownership in different companies. And we've seen over the last 10 years how well stocks have done and have returned money for people. I was just looking at a stock today. Shopify had a very, going from $100 to close to $500 in only a couple of years. So some stocks can return quite a bit of money, given the right circumstances, to their investors when things are good, meaning revenues are increasing, and in some cases, profits are increasing. And that's what you are going to try and do in the simulation, is you're going to try to increase your revenues and increase your profits, because that's what increases the stock price, and that's what people who lent you money want you to do, to maximize that wealth. So the money market I was talking about before, just a little bit more detail on that. The maturities that are will expire within a year. So money markets, because they're more short-term debt instruments like treasury bills, commercial paper, these are instruments that were shorter terms, so they don't pay a lot of interest, but they pay more interest than the savings account. So where a savings account pays a fraction of an interest rate, maybe the money market account will pay 1 or 2% interest. So if you're somebody who has some money in the bank and you don't need it for a year or 8 months and you want to get a little bit extra interest on it, you can put it in the money market account. It's generally considered very safe, a very low chance of losing any money, and earn a little bit extra interest. So what you don't want to do is have a lot of money in a savings account earning almost no interest. So why have $100,000 in the savings account earning no interest when you could put that in a money market account, which is just as safe, and earn 1 or 2% more? Or then maybe have it in a mutual fund index and earn even more interest tax-free. So that's why people who have money will pay for a financial expert to help them manage their money, to get the most from their money by explaining to them their potential return and their potential risks. So these are generally the least risky areas to invest your money. And there's some companies that may accumulate huge sums of money temporarily. So for example, if you're a company who is holding money, say for example that maybe you're a cable company or a phone company and you're forcing people to pay their bill in advance at the beginning of the cycle, rather at the end of the cycle, you may have hundreds of millions of dollars. They're sitting there in a bank account that you can actually invest for a short-term period before you need to utilize it and earn a little bit extra interest on it. And that's another thing. Money market accounts can be used by businesses for that. Now, the euro currency market is also another money market. So when you say money market, we're thinking a lot of U.S. Treasuries, commercial paper in the U.S. market, but there are this euro currency market, which is an equivalent of our domestic money market, but now we're dealing with a few other outside influences. But it's still bank deposits denominated in U.S. dollars. So with the money market, you may have people interested in managing or working with dollars, but don't want to be involved in the U.S. financial system. So say you're a country like Iran and you have sanctions, you really can't deal with the U.S. banking system because your sanctions will prevent it. The euro currency market will be a market outside the United States that is denominated in dollars that the U.S. regulatory agencies have no control of. So that could be advantageous for countries like Russia or countries that may not want U.S. interference in their banking transactions. So then you might say, well, why does Iran and Russia need to do banking in U.S. dollars? Is because the U.S. dollars are reserve currency, and there are certain commodities like oil are primarily only traded in dollars. So if you're Iran and you're selling oil, you're going to be accumulating dollars, and if you want to move these around, you're going to have to go to a money market outside of the U.S. jurisdiction. And that's why these, what we call euro currency markets were developed to facilitate transactions in dollars that are outside the U.S. And being a currency that's a dominant currency in the world, there's a huge amount of U.S. dollars circulating outside the borders of the United States, trillions of dollars. There are some whole countries that just took their currency, threw it in the trash bin and say our currency is trash, and assume the U.S. dollar as their currency. So if you go to Ecuador or Panama, their currency is the U.S. dollar. And there's a number of countries that just took their currency, threw it in the trash because we can't be trusted with currency, threw it away, and just run their economy on U.S. dollars. And there are certain countries where they may have their own currency, but if you whip out some U.S. dollars, they'll gladly accept those too, because they're highly sought after, especially in countries which have a high interest rate, because a high inflation rate. Because the U.S. dollar has a more stable and lower inflation rate and holds its value longer, so that's why a lot of investors in other countries may want to have some of their investments be dollar denominated as well as local currencies. Let's switch to the capital market. So this is a long-term market, and it's a market that enables, again, suppliers and demanders to get together to transact in more longer-term instruments, such as stocks and bonds, which we can call debt and equity. This is how we keep finance confusing, is we have multiple names for the same thing, like sales and revenue. We need to keep finance confusing so financial analysts and financial consultants can charge a lot of money by making average people think finance is so difficult. So when we say stocks and bonds, we really mean equity and debt. Stocks are equity, bonds are debt. Those are just different names for it. And a lot of times you'll see in financial shows, big, high-powered financial people on these financial shows will always use the term equities or this equity because they want to sound like they know what they're talking about. So if you're in the know in the financial lingo, you stay with the more lesser-known, more business-oriented terms, so you convince people that you know what you're talking about. Now, we all have a good sense of what stocks are. You might be less familiar with bonds, but bonds are basically just a loan to a company that they're going to pay back the principal. The principal is the money you originally lent with interest. Now, stocks are selling ownership in a company. We'll get into more of that throughout this course as well. But when it comes to bonds, it's similar to you lending money to friends, right? So you might have three friends. One of them is completely unreliable, borrows money from you when they're drunk, and then claims they never borrowed it once they're sober after they blacked out. So you're very hesitant to lend them money. A second friend is very reliable, pays you back, Venmos you the money the next day. So you're a little bit, charge them zero interest rate because it's a friendly money you're lending and you know they're good for it. Somebody else that might be a lot more risky, you might want to have a contract, you may want to establish a interest rate with them because there's a good chance that they're not going to pay you back. So that would help compensate you for the risk. For example, you might want a collateral. So you say to your friend wants to borrow $100 to buy a round of drinks for other people, and you say, okay, tell you what, give me your car keys, and I'll have your car and your car keys, and when you pay me back, I'll give you your car keys back, also when you're sober. So then the next day, when they say, hey, where are my car keys? Well, you borrowed $100 from me, you don't get your car back until I get that money back. That's called collateral. So the same way when you borrow money for a home, a mortgage, if you don't pay your mortgage, they take your house as collateral. So that makes you feel a little bit more secure in the knowledge that if they don't pay you back, you have an asset to compensate you. Okay, so common stocks are it's ownership in a corporation. So if I own one share of McDonald's, I'm technically an owner of McDonald's. But if I go into McDonald's and say, hey, I own this company, give me some free food, they're going to laugh at me because I have no voting power of any significance to make any decisions in the company. If I had a majority of the McDonald's shares, then I would really be the decision maker in McDonald's, the majority owner, and I would get free food all the time. So it's really about your percentage of ownership that gives you controlling interest in the corporation. So you may be a part owner, but a very small part owner that no one cares about. But once you accumulate a certain block of shares, you become more significant, more influential, and can help the company make more decisions, or you're voting, because stock has voting rights, and that gives you power in your shares of stock. Now, preferred stock is a special classification of stock that is, just the name preferred to say it's better, right? So we like to fly in preferred seating, or we want to go to buy the preferred package. So it always means you're getting something more. So when you buy preferred stock, what you're getting is a guaranteed dividend. So for companies, when they sell preferred stock, the benefit of selling preferred stock is that, unlike a bond, it doesn't have to be paid back. So when you issue a bond, you have to pay interest, and you have to pay the bond back at a later date, usually 30 years. With preferred stock, you pay a guaranteed dividend, but you never have to pay back the principal invested. So it's until you actually want to maybe possibly repurchase the stock, but there's no timetable to have to do that. So there's a little bit more flexibility. Okay, so in the capital markets, we have what's called a broker market and a dealer market. So these are two different markets. They work pretty much the same way. It's just sort of smaller classifications. It's sort of like, if you go to Burger King or McDonald's, they're clearly different operations, but you're getting very similar food or similar service. Now, the securities exchanges, and the biggest one you're most familiar with would be a stock exchange. So they're going to provide a marketplace where funds can be raised through selling securities, and where purchasers can resell the securities, and that would be a securities market, and that's what we look at mostly for stocks. Now, a broker market is another type of securities exchange where a buyer and a seller are brought together through a trade specialist, you could sort of say. Now, in the broker market, think of the New York Stock Exchange. The New York Stock Exchange today is highly computerized, but in the past, all the trading took place mostly person to person on the trading floor in the New York Stock Exchange. These broker markets were more, they came about first. So before computers, back into the 1800s, we had these broker markets where people met and traded slips of paper, which represented the ownership, the buying and selling of shares, and everything was recorded on paper ledgers. So a broker market is a more traditional market where trading floors, you have brokers on the trading floor who actually facilitate the buying and selling of stock. Where dealer markets started much later in the 19th century, and they're more computer-assisted or computer-aided. So a dealer market, there is no physical marketplace like the New York Stock Exchange. It's a network, a computerized network that is linked together that makes the trades. So there is no physical person-to-person exchanging of slips of paper or verbal agreements. It's people bought together directly through an internet-like network. So since there's no centralized trading, this network can occur almost anywhere, and you basically hire what we call a market maker, and they're going to marry up the buyer and seller together in this communication network. So it'd sort of be like a matchmaker where they're going to help people find somebody to marry. So the market maker does the same thing. They're going to connect the people who want to buy stock to the people who want to sell stock and make a market in between. In each case, whether it's the dealer market or even the broker market, how these people make money is through the spread. So so the compensation is going to be the spread, which is the difference between the ask and the bid price. So it's a basic concept of, think of the financial broker or market maker as a business person. So they're going to want to buy at the cheaper price, sell at the higher price. Okay? So the ask price, that's the lowest price the seller is willing to accept for a security. And the bid price is the highest price a buyer is willing to pay for a security. So if you're a market maker, you're going to buy from sellers at the bid price, which is generally is always the lower of the two prices. So the ask price could be $5.25. The bid price could be $5. So if I'm a market maker, I want to buy the stock from you guys. All the people on this side of the room want to buy the stock from you for $5 and sell it to you people over here for $5.25 because you want to buy, you want to sell. So I'll buy from you at $5 and then sell to you at $5.25. So I make the spread, the 25 cents in between, because you, as a director owner of stock, cannot easily sell directly to somebody else without the market maker, broker, or financial markets in between. It is possible, but rarely done. It's just much easier to pay the spread and, well, you don't actually pay the spread, to sell it at a slightly lower price than the ask so the market maker can make the difference. And nowadays, these spreads are typically 1, 2, 3, 4 cents, very small amounts of money, because the more competition in buying and selling in these money markets, these money makers, is they're willing to set these small these small spreads because they're doing millions and millions and millions of shares, and that millions of pennies adds up to a lot of money. So ask price minus the bid price is the spread amount that compensates the brokers and the market makers for their efforts in setting up the market and, in some cases, holding inventory which they could of stock, which they could lose money on if the price moves too quickly. Okay, so let's talk a little bit about international capital markets. So generally, around 50% of the world's capital are in the U.S. capital markets. So our capital markets are huge, and we hold a lot of money. In fact, a lot of foreign stocks will trade their stocks in the American stock exchanges. So if you're a big up-and-coming company in China, you want to be on the New York Stock Exchange to access more capital. If you're an established company from Japan or Europe, you're already on the New York Stock Exchange, and because this is where the money's at. But there's still the rest of the world still holds 50% of the money, and they have foreign capital markets like the Euro bond market, which are bonds denominated in dollars but sold to investors outside the United States because dollars are a lot more liquid and a lot more stable. So foreign companies may want to be raising money in dollars. Specifically, if they're going to be a foreign company, they may want to raise their money in dollars if they have to spend dollars to build a manufacturing or a distribution site in the United States. There's also a foreign bond market where there are foreign bonds denominated in foreign currencies. So we have bonds in all sorts of currencies. Many of them are in the euro, as generally some of the big world currencies. The euro is a distant second place as far as a major currency, but there are a lot of bonds based in euro. So if you have a lot of countries may want to facilitate, especially if they're in the European Union, facilitate their bonds in euros. And we have international equity markets. So many countries have their own stock markets. Egypt has their own stock market. Iraq has their own stock market. Some countries will share a regional stock market. Of course, China has stock markets. Japan has stock markets. Even Canada has their own stock market in Toronto. So this is to help facilitate local companies to access local capital markets. So you might have, in the Canadian exchanges, you have a lot of gas and oil companies. And oftentimes, these companies could be dual listed in Canada and the United States. But you could also, as a United States citizen, your local broker, Fidelity, Charles Schwab, can access those foreign markets. You have to pay an additional commission to do it. So if I wanted to buy a Canadian stock, I could do it on the Toronto Exchange through my local broker, but I'm going to pay additional commission, and I'm also going to have to assume a foreign currency transaction because they're going to have to convert my dollars into Canadian dollars to buy the stock. And these all add up extra costs. And that's generally why a lot of domestic American investors don't want to buy stocks on foreign exchanges, that's going to cost them extra fees and commissions, and that's why these companies come to us and get listed on our exchanges. But there are still many companies that you can't access through the U.S. Stock Exchange. They can only get through, say, the Tokyo Exchange. For a while, Sony has been on the New York Stock Exchange for a long time, but for a while it was difficult to buy Nintendo as a domestic. All right. I hit the wrong button. All right. Okay, here we are. Okay, so the efficient market hypothesis, what is this? This is basically saying we have all these buyers and sellers of stock. So we have a good deal of people looking at stocks and saying, this is a good price, I want to buy that. You have a number of people saying, I don't think the stock price is going to go up much higher, I'm going to sell it. So all this buying and selling of stocks helps to make a price we're going to call efficient. So if you have thousands and thousands of people looking at Microsoft, they're all making judgments with their purchases and selling of the stock. Eventually the price of Microsoft is going to be worth what it's truly worth today. Basically, what's the value of anything? It's what people are willing to pay for it. And that's what the basis of this efficient market hypothesis is really saying that at any particular point, stocks are fully and fairly priced based on all the active investment in the company. This is what investors are saying, and these investors many of them are highly skilled, highly trained, with good experiences. This is what they're saying the stocks are worth. So we call the stock markets efficient because of all this activity. So if anything became inefficient, very undervalued or very overvalued, eventually through time and trades, it would come to a more neutral position that would be more reflective of their true potential. Now, one thing, so you might be asked, well, how do stock market bubbles occur if we are supposed to have this efficiency? And how does this valuation jump around on stocks if everything's supposed to be efficient through the trading? Well, once we get to a position where computer AI does all the stock trading, then we'll truly be efficient. But for right now, we have to deal with behavioral finance, which basically is the fact that humans who trade stock have emotions, and they trade on fear and on greed, and then this causes extreme shifts in the value of certain stocks. So you could have a stock that's very valuable, and then a potential virus outbreak occurs, investors panic, and the stock price goes down greatly. Only for a few days or a few weeks later for them to realize, hey, this really wasn't a catastrophe that we thought. This really isn't going to affect business as much as we feared, and the stock price bounces back once reality comes back in and says, this is overdone, oversold, because fear got a hold of investors a little too much. And then sometimes greed comes in. So the stock market's going up, people are doing very well, people get greedy, want to put even more money in the stock market to make more money. So that greed can fuel a bubble in the stock market. So people's behavior, irrational behavior in the valuation of stocks and the way they predict stock prices can lead to these extreme overvaluations of stock or undervaluations of stock, which makes investing very volatile and tricky because of the flaws in the way people think due to their human behavior. That's why experienced traders who've seen a lot, understand a lot, they're less affected by these bad behavioral impulses, and they make money or trade a little bit more successfully because they have their emotions under control and they understand a more longer-term view of the stock market and how things work compared to a more recent, newer trader who doesn't really understand these dynamics as well because they're not as experienced or mature in their trading. Now, when it comes to financial markets and institutions, we've had a lot of problems in the past of companies behaving badly, individuals behaving badly. So we had to have government regulations placed on the financial markets to help keep them safer from individuals. So way back, we had something called the Great Depression. And the Great Depression, we realized how risky banks had become, and so many banks went bankrupt and people lost their savings, that a Glass-Steagall Act was enacted to sort of separate the risky aspects of banking from the safer aspects of banking. So they said, let's take the risky underwriting and trading and all the stuff the investment bank does, and we'll break the bank up into the investment bank, doing all the risky, high risk, high profitable stuff here. And then we'll take the commercial bank, we'll put it over here, it'll be all the low risk, common business stuff that individuals need. So that business is at a low risk, so people won't lose the money, and that way we'll keep investors a little bit safer. And because of this Great Depression, where people lost their bank balances, people were afraid to use banks because they thought they would lose their money. So the government stepped in and said, FDIC, we're going to ensure that the money you put in a bank will be paid to you even if the bank goes bankrupt. Or if the bank steals your money and runs away, the government will step in to secure it. So once again, creating a feeling of safety and security in the banks, and having people bring their money out from under their mattress and deposit it into banks. Because that is what keeps the economy moving, is this flow of money, banks to investors and back to savers. So the government wants to make sure that that momentum is going to keep occurring. Now, the Graham-Leach-Bailey Act, when it looks at mergers between commercial banks and investment banks and insurance companies, so they want to make sure that these institutions can compete in the market prior to regulations that prohibit them from entering them together. So at one point, this Glass-Steagall Act, after a number of years, they said, well, another big depression is unlikely to occur, so let banks be banks and let them buy each other. So we let banks make their own rules again, and guess what happened? The Great Recession happened. So, oops, I guess we should have probably not have done that, because banks went back to their bad behavior again and risked the whole economy. The whole economy during the Great Recession became this close to shutting down and this world becoming Mad Max. We really came very close to that. So Dodd-Frank, Wall Street Reform, and Consumer Protection Act was sort of like, okay, we have to really regulate banks and financial institutions and people's money a little bit more than we thought, because apparently when we're hands off, the proverbial SHIT hits the fan. So government has sort of went from tighter control after the Great Depression, loosening it up in the 90s, to another Great Recession and tightening those controls a little bit more. In the middle there, we also had a ethics crisis around 2002, 2003, with Enron being the poster child for bad corporate behavior, that other regulations were imposed on financial CFOs and financial vice presidents, that they have to take more responsibility in how the company's represented, and that companies have to be looked at a little bit more closely to make sure they're not falsifying their profitability and their revenues, all in order to increase stock prices. So basically, as businesses do bad things and people get hurt, the government steps in to make regulations to sort of try to improve it for the investor. Okay, so going back to the 30s, during the Great Depression, a lot of companies were fake. So they would, ever have, this term catfishing, right? There's a whole show on this where people make a fake profile, and this is what banks would do. They would catfish people. So they make a fake bank or a fake company, and they get investors' money in this fake company, and then it was really nothing to begin with, and they run away with the money. So these shenanigans, which caused the federal government to make the Securities Act and the Securities Exchange Act of 1933 and 1934 to create a government entity, the SEC, Securities Exchange Commission, that's going to regulate companies and say, okay, before you can go public, you've got to be real, you've got to have financial statements, certain things that you have to file with us, so that we can protect the individuals who invest in your company. So they created a Security Exchange Act to do, among things, such as prevent insider trading. So to keep the markets fair and to keep the individual investor a little bit safer by possible wrongdoing that companies can do when they issue stock. So they're basically saying that try to keep companies a little bit more honest, and the exchange is free of fraud and unfairness. So the Securities Exchange Commission, they're going to enforce these federal securities laws to make sure that what the company says their financials are and what their business is legitimate. Now, let's move on to issuing common stock. So you're a business, you come up with a great idea for an app. I have an app that's going to do this. That, that famous Seinfeld episode, George creates the app that will find the best toilet. So it's a toilet rating system, say in New York City, I need to go to the bathroom, where's the 5-star toilet I don't have to pay for, that's not crowded, so this was of course a joke, but somebody does come up with some sort of idea, and maybe it's a dating app, maybe it's a ride-sharing app, a food delivery app, a financial stock trading app like Robinhood, and they come up with this idea. It turns out to be a good one, and they want to start to grow the company. So the company started with 1 or 2 people, but now they need additional funding. So they could do private equity, sell some stock privately. So I own this company, and if you give me $1 million, you can own 5% of the company. See Shark Tank if you want to know kind of how that works and those negotiations and how businesses who have companies interact with investors who have a lot of money. Just see an episode of Shark Tank if you want to know how that works. Angel investors are this is also kind of related to Shark Tank, but angel investors who have a lot of wealth and they want to make investment decisions, they're willing to promote and help startups and provide them with a significant amount of money and also possibly sometimes talent or even office space. Angel investors sort of are just wealthy individuals who have a knack for picking out businesses that have a good chance of becoming very big businesses. So when you get a little bit more established, you have these venture capitalists and venture capitalist funds, where these are professional entities that have a lot of capital from a pool of rich individuals that they're going to have a management team that are going to go out and invest these in growing companies. So there's just tons of money out there that is looking for better returns and returns earlier in the company's life before they're a public company, and venture capitalists are often there to facilitate that. And a favorite thing of venture capitalists may be buying 5 or 6 small companies, putting them together with synergy to make a mid-size or a large company, and then reselling stock for that company. So they do a multitude of things to create value for investors. Okay. So when we're looking at deal structure and pricing, so we want to figure out how much is a company worth and what different deals can people who want to invest in these companies make. So when it's early on, these structures can be negotiated through contracts with the existing owners or the founders about how much capital is going to be deployed, what other factors that could be favorable, maybe distribution rights, if it's sort of, say it's a big company that wants to work with a smaller company, they may get some ownership in that smaller company and then open them up to their network. So for example, if Coca-Cola sees a small beverage company and they want to own a good percentage of it, then they might just go ahead and invest in them and open up Coke's distribution network to their product to get wider exposure. And generally, the payoffs are bigger for venture capitalists. So when they have these deals or these pricings, they get much more favorable terms than if it's a public stock. So they get a higher percentage of ownership for less money because they're investing in a more earlier stage or riskier stage. And since they're taking on bigger risks, they get generally a larger percentage of ownership in the company. And in some cases, they may have to wait many years before the company finally goes public to get their big multi-billion-dollar payout. Okay, so let's just look at organization and venture capital investors. So if you're a small business, you have, when you're, how can I explain? Smaller businesses have different needs and different access to capital markets. So typically, if they want a lot of money, a small business can't easily issue stock, can always easily issue bonds. That's why they usually turn to venture capitalists to provide some of that funding. So you might have financial venture capitalists that stick mostly to their subsidiaries of financial companies, particularly banks that are specialized to help younger firms and maybe become better customers of the institution. So if you're a banking entity, you might want to foster these venture capital relationships with companies in the guise of, helping drive or create your future business. Corporate VCs, they're looking to mostly deal with non-financial firms to gain access through development and exploitation of new technologies, access to future drivers of growth. So you may have big corporate accounts, like, say, you have big beer beverages that are looking to work with corporate venture capitalists to get stakes in smaller cannabis companies. And you may have big cigarette companies looking to take stakes or venture positions in vaping companies, which lately has not turned out so well in either case. Both those vaping and cannabis companies have lost a lot of valuation recently. But this is a way of sort of using this corporate VC to kind of branch out into new businesses, new investments. All right. So let's say you want to go public. If you're going to issue stock after the private placement, you have to be a company of a certain size and a certain demand. So you can't issue stocks for a company no one wants to buy. But if you're an up-and-coming tech company that's on the tip of everyone's tongue, everyone's maybe used or know about it, and they can see how this is going to be a big business in the future, that's a great stock to go public because there's going to be a lot of demand for that stock. So the company will go to an investment bank, which we're going to get to in a second, and the investment bank is going to help facilitate that. Now, once a company is going public, they have a rights offering, which if you're a private owner that owns 5% of the company, a rights offering may guarantee you a position to buy an equal amount of public stock so you can maintain your 5% of ownership once they go public. But the public offering is generally bringing in new shareholders and changing the ownership percentage of the company. So the IPO is what the investment bank is going to put together. So the investment bank, you're going to come to an investment bank and they're going to say, okay, we think you are a good candidate to go public. So what we're going to do is we are going to help you go public, but not for free. We're going to either charge you money or charge you a differential in the stock. So maybe the stock goes public at $25 a share, but we're going to have X amount of shares that we're going to be able to buy at $15 a share. So we'll make the differential when we sell it in the secondary market. So somehow the investment bank will get paid, but they're going to facilitate with their team of lawyers and accountants, marketing specialists, and selling network. They're going to facilitate a successful IPO. But the investment bank won't take on a company that they feel is not going to be a successful IPO because your reputation is at stake. So a prospectus needs to be created, and this prospectus is a document that's going to tell you all you need to know about the company's financial position, what their business is, their management's ideas and concepts, their financial statements. So a prospectus is sort of like a brochure of what the company is about, just like you might want to look at a brochure before you buy a house to just get to know what are the assets, what are the advantages, disadvantages, so you have an idea of what you're buying before the company goes public. The red herring is a term we use for preliminary prospectus. Investors get during the waiting period, which is between the registration filing statement and the SEC approval. So basically, it's sort of like a pre-prospectus. And then we have the quiet period. So when the prospectus is issued, then nobody in the company can talk about any new stuff that's happening at the company, because that would be deemed insider information or unfair, since it's not in the prospectus. So they just have to remain quiet until the company actually goes public. Then they can announce these things after the quiet period. A roadshow is just a promotional engagement for the public company. Just like, say, a new movie will come out, and the actors for the movie will hit up all the talk shows and do interviews in print and media and online to kind of drive demand or awareness of a particular new movie or TV show. It's the same thing with a roadshow here, where they go out and pound the pavement and make awareness for the new stock to drum up demand, because they want that stock to pop that first day. They want it to go from $25 a share to $75 a share. So to do that, they need to create a lot of demand for the stock, and that's what the roadshow is about. So the investment bank's role, they're going to be the intermediary between the company and the financial markets. So there's a lot of regulations and paperwork and accounting. A lot of things have to be done in order to satisfy all the requirements of going public. So this underwriting role means that the investment bank is going to take the risk of reselling the stock to investors. So they're going to say, yeah, we're going to guarantee all your shares are going to sell because we have drummed up the demand and we have a network of potential buyers for your stock. But what the investment bank tries to do is keep that initial IPO price as low as possible, so that way it can reward all its investors when that IPO pops that first day. That's why you hear of a lot of stocks when the IPO comes out, the prices go up, in some cases 50, 100, 200% that first day, which is a big win for the investment bank and their investing syndicate. So the IPO offering price is something that's going to be negotiated and worked on between the investment bank and the company. The company wants the highest price possible because they're getting that money directly. The investment bank wants a lower price so that they could drive value for their investing syndicate. So you have this the originating investment bank. They're the ones who take on the client, do all the paperwork, have the accountants and lawyers setting up the whole deal. The underwriting syndicate is a group of other investment bankers and other financial investors that they're going to sell through. So they all kind of work together. If one investment bank has a great IPO stock that they're working on, they're going to work with the other investment banks and other underwriting syndicate potential buyers to sell this out. The really sad thing is, though, people like us can't buy an IPO. It's only for the rich and the big mutual funds and pension funds and individual wealthy investors. They could get to buy the IPO. We can't. What we can do is buy it the first day after it's gone up 25% when it's first been traded. So we're not able to access. You have to have big money to access the IPO. If you're a mutual fund with billions of dollars, get a piece of the IPO. Little guys like us, we can't buy the IPO until it's traded in the secondary market. So we have to wait to 9/31 when it's first issued and the first shares go for sale in the secondary market, and we're typically paying a lot more for these IPOs. And this is one way the rich get richer and we don't, because they have access to these IPOs. Now, there's a tombstone, which is it's sort of a list of this underwriting syndicate that are going to be involved in the IPO perspective. They're going to be in the prospectus. And then you have the selling group, which is a number of brokerage firms that are going to connect large pension funds and insurance companies and large investors to buy this IPO. So it kind of graphically could look like this. The company issuing the stock, they could go to the originating investment bank who works with other investment banks to get to a very large selling syndicate, a group to sell to, which is going to then hit the primary market investors. So it's really the gatekeeper. You can't get into be an IPO. It's very hard to be an IPO without an investment bank's involvement, and this is why these investment banks just make millions and millions and millions of dollars, is because they have the market cornered on these IPOs. So the total proceeds of the sale of the stock is going to be the IPO times the amount of shares issued. So that would be the total proceeds. And then the market price is whatever the reaction is to the IPO. The buying and selling that occurs later will set the market stock price. So there's a beginning price, and then there's a market price after it starts trading. So the capitalization is simply the outstanding shares times the current stock price, which also called the market price. If you hear the term market price, it means stock price. So if you have 1 million shares outstanding and it's $10 per share, the total market capitalization, multiply the two, $10 million. And that basically says how much the company's worth. So if you want to see how much Netflix is worth, just go to Yahoo Finance, look at the market capitalization, which is outstanding shares times stock price. It'll tell you the total current value of that company. And we're having some companies like Apple and Google hitting $1 trillion and Amazon hitting $1 trillion worth of value. Okay. Now, so the IPO market price is the final price agreed upon that it's going to begin sales on. Then the IPO underpricing is the change from when the IPO was listed to what the final trading price is in the first day it trades. So if the stock was listed at 50 as the IPO and it goes up to 100 that first day, then we could say it was underpriced by 100% or 50%, depending on which way you're looking at it. So it's just figuring out the starting position, the ending position in the first day. And if the stock price goes up, the stock was underpriced. If that stock price goes down that first day, which can happen, then it's considered overpriced on issue. Typically, most IPOs are underpriced, and the price goes up the first day of trading. Okay, so securitization, financial institutions and real estate finance. So securitization is just a process of recycling mortgages. So a bank originates a mortgage, and what they do with it is they say, okay, we have this mortgage, but they took up a lot of our money to lend this money out, and as a bank, where we make more money from originating mortgages than holding them. So the bank will sell the mortgage to an investment pool, and that's the securitization process. So mortgage-backed securities is an investment pool that's buying mortgages from all these different banks and selling them back to investors, and the bank gets a refill of money from selling the mortgage, and they can lend it out and then create another mortgage, because the bank makes a lot of money on fees and commissions for originating the mortgage. And they can make more money by originating mortgages than by holding it. And we could also capitalize more people to buy houses if the money is being pushed up to the investment market and the investment market's recapitalizing the banks. So we have a faster cycle of money, so there's always money for people to buy houses. So it's a good thing. But when things get a little crazy, like in 2007, where there was an overactivity in lending, where special mortgages were created and looser lending practices occurred, where a lot of mortgages that were issued should never have been issued, but were issued in the sole fact that real estate prices don't go down. So if the mortgage gets into trouble, we can always claim a higher priced house as collateral and we'll be fine. And that all worked out very well for a long time until the housing prices started to fall. Then people were stuck in these mortgages they couldn't afford, and they couldn't sell the house to get out of the mortgage, and that's when the whole house of cards kind of collapsed and created this, and this is where we can see graphically where the home prices started to fall in 2006 and 7, and that's what created this housing crisis. Because suddenly houses who were greatly overvalued became more fairly valued, and huge losses as people defaulted on these banks, on these loans, and then that all sort of cascaded into the global economy, and there's a crisis of confidence in banks. So people were afraid that banks would fail. But only 3 banks failed in 2007. 25 banks failed in 2008, and 140 banks failed in 2009, and 157 banks failed in 2010 because the investors were just not paying. People who were getting these mortgages were not paying for them. They were defaulting on them. So that was putting a lot of banks out of business. So the spillover into the general economy, one of the big things this did was to crash the stock market. So people suddenly felt that the economy was tightening, credit was tightening, you couldn't lend easily, so it's hard for businesses to get money to expand their businesses, thereby creating this great recession where it was difficult for the economy to move forward. And this was took an extreme act by the government to push the economy, restart the economy. So as banks were skeptical about lending, and as credit markets started to seize up, the government stepped in and then pushed a bunch of money into the markets and reassured the economy that the credit is available, and even encouraged banks to lend it out. That would, in conjunction with new regulations and new laws, help to prevent us from becoming another Great Depression. So we very luckily escaped that Great Recession in a matter of years. By 2011, 2013, things were really well on track till today, where things are still doing well. Okay, so that's it for Chapter 2. Thank you for listening, and I'll see you next class.